All right, let's talk retirement planning. You're looking to diversify. Maybe you've heard about gold, that physical asset appeal. And gold IRAs pop up as this way to, protect your nest egg. But here's the thing. Do you really know the hidden pitfalls? The details that can flip a tax advantage into, well, a serious penalty. Today, we are doing a deep dive into gold IRAs, specifically the absolutely critical IRS regulations that govern them. And we're basing this on an expert bulletin, one that really digs into business research and market analysis for gold IRAs and precious metals. So, our mission for you today, it's simple. Pull out the most important nuggets of knowledge on gold IRA compliance. We want you to understand the consequences, sure, but maybe more importantly, why these rules exist and how you can steer clear of trouble. Think of it as a shortcut to being really well informed. Keep those savings secure, keep them tax advantaged. Okay, let's jump right in. Most people get the basics. Gold IRAs let you hold actual physical gold, which is pretty different from your typical IRA holding stocks, bonds, mutual funds. The appeal is obvious, right? A hedge against inflation, maybe economic uncertainty. Great for diversification. Plus, those potential tax perks contributions might be deductible. Earnings grow tax deferred. Sounds good.
It does sound good,
Huh.
and all that's true. But, and this is a really significant, but there's a catch. Those benefits, they come tied to a very specific, pretty stringent set of rules from the IRS. It's actually kind of striking how often seemingly small mistakes can lead to major penalties. Understanding these rules isn't just about dodging a fine. It's really about preventing things that could seriously damage your financial security. You could even lose those tax benefits completely. See, the IRS has these strict guidelines for a reason. They need to make sure gold IRAs are used purely as long-term retirement vehicles. That's the intention. They're essentially protecting the integrity of these tax-advantaged accounts. So if you stray from the rules, well, you could lose the tax advantages entirely. It could be financially devastating, frankly.
Okay, let's unpack that a bit. These rules sound complex. What are the most common ways people maybe accidentally trip up with their gold IRAs? And what actually happens then? What are the consequences?
Right. So we've seen about 5 key areas where non-compliance pops up frequently, and they all carry pretty significant consequences. First off, let's talk early withdrawals. It's basically what it sounds like. You take money out of your gold IRA before you hit age 59 and a half. The fallout is, well, painful but straightforward. You get hit with a 10% penalty on whatever amount you withdrew. And you also owe regular income tax on that distribution. So, for example, say you pull out $10,000 early. Bam, there's a $1,000 penalty right there. Plus, that whole $10,000 now counts as taxable income for the year. It's almost like the IRS tapping you on the shoulder saying, hey, remember, this is for retirement, not for that new boat.
Yeah.
It really hammers home the long-term purpose.
Gotcha. Okay, that one makes sense. But then there's something that I think catches a lot of people off guard because it feels wrong somehow. This idea of keeping your gold close. Maybe storing it at home where you feel it's safest. But my understanding is that seemingly logical idea, it's actually a huge problem with the IRS, isn't it? Why is home storage such a red flag?
Absolutely. And that leads us straight into the second big pitfall, gold storage at home. Look, I get the appeal. Having your gold safe under your own roof, it feels secure. But it is a massive no-no according to IRS rules. Huge. The IRS is very clear. Your gold IRA assets must be held by a qualified trustee or custodian, and the actual precious metals. They have to be stored in an IRS-approved depository, period. This isn't just about, preventing theft. It really gets to the core of what the IRS sees a retirement account as. It's a trust relationship. By requiring an approved custodian, they ensure there's an independent third party involved. It prevents self-dealing. It reinforces that this isn't just your personal property you can access anytime. It's a controlled, tax-advantaged account. And if you ignore that and store the gold at home, the IRS considers that a distribution. The entire amount becomes taxable income. And yep, if you're under 59 and a half, tack on that extra 10% penalty too. I even heard stories someone thinks they're being clever, maybe stores just one gold coin at home. They don't realize that single act could trigger a deemed distribution of their entire gold IRA balance.
Wow. Yeah, those small oversights turning into big surprises. That's a really powerful warning. Okay, what's the next common mistake you see people making?
All right, number 3 is excess contributions. This is when you put more money into your gold IRA in a given year than the annual limit allows. The consequence here is a 6% penalty, and it's on the excess amount. But here's the kicker. That penalty applies each year. The excess money stays in the account. It doesn't just go away.
Oh, wow. So it keeps hitting you.
Exactly. That 6% can really start to bite over time if you don't fix it quickly. To correct it, you've got to identify how much extra you put in, withdraw that specific amount, plus any earnings on it, and then obviously make sure your future contributions stay within the limits. It really just highlights how important it is to stay current on those contribution limits. They can change year to year. And that recurring penalty, It's designed to make sure you pay attention.
Okay, makes sense. Now, thinking about people closer to retirement or maybe already in it, there comes a point where the IRS says, okay, time to start taking some money out, right? Can you explain required minimum distributions, RMDs, for Gold IRAs, and what if you just don't take them?
Yes, absolutely. That's our fourth common scenario. Failure to take required minimum distributions, or RMDs. Once you hit age 73, the IRS requires you to start withdrawing a minimum amount from your traditional IRAs each year, and that includes Gold IRAs. And if you fail to take those RMDs, or don't take out the full required amount, you face a pretty stiff penalty. It could be up to 25% of the amount you should have withdrawn but didn't.
25%, that's significant.
It is. Now, there is a bit of a potential break. If you realize the mistake and correct it within 2 years, the penalty might be reduced to 10%. But still, 10% is not nothing. This is really the IRS's way of saying, okay, the tax deferral party isn't going to last forever. They expect to eventually collect tax revenue on all that growth that's been happening tax deferred. So, yeah, tracking your RMDs becomes crucial as you approach and enter retirement to avoid those penalties.
Right. Okay, one more common pitfall, and this one feels like it could be tricky. Ineligible gold investments. I mean, gold is gold, right? Or is it, I imagine not just any shiny bar can go into an IRA.
Exactly right. You can't just put any old gold into your IRA. That's a critical point. So the fifth area is investing in gold that doesn't meet the IRS's strict guidelines. Purity and proper custody are absolutely non-negotiable here. Generally, the IRS requires gold to be at least 99.5% pure.
99.5, okay.
Yes. And again, it must be held by an approved custodian in an approved depository. You can't get around that. So eligible examples would include certain specific gold coins, like American Gold Eagles, for instance. Even though they aren't 99.9% pure, they have a specific exception. Or gold bars that meet the purity requirements from an accredited refiner. What's kind of fascinating here is how these rules, the purity, the custody requirements, they really force you into a specific part of the gold market within your IRA. It's often less liquid than just buying any gold off the street. You can't just buy any bar you find.
Ah, okay, so it limits your choices a bit.
It does. It limits your choices, and it can also impact your exit strategy down the line. That's something really important to consider for long-term planning. And the consequences for getting this wrong. If you invest in ineligible gold, the IRS can deem your entire IRA balance as distributed, taxable. And again, if you're under 59.5, that extra 10% penalty applies too.
Wow. Okay, so those are some serious pitfalls. Early withdrawals, home storage definitely don't do that, excess contributions, missed RMDs, and ineligible gold. We've looked at the problems and, crucially, the reasons the IRS has these rules in place. So now let's pivot. What are the concrete, actionable steps someone can take? How do you make sure your Gold IRA stays compliant, stays secure, and you avoid all these potential headaches?
Right, let's talk proactive strategies, because you absolutely can navigate this successfully. One of the most important steps, maybe the most important, is choosing the right Gold IRA company and an experienced custodian. These are your partners. The Gold IRA company, they're sort of your guide. They oversee the whole setup process. They'll help you with the account setup, assist with funding it, maybe rolling over from another retirement account. They help you choose and actually buy the IRS-approved precious metals. And they often liaise with the custodian for you.
Okay, so they handle the front-end stuff. What about the custodian?
The custodian is crucial for compliance. They handle all the aspects involving the IRS rules and procedures. They are the ones who arrange for the storage of your metals at an IRS-approved facility. They handle the paperwork, the reporting to the IRS. Essentially, they're the IRS's eyes and ears for your account, making sure things are done by the book. So it's absolutely critical to choose a custodian with specific experience in Gold IRAs. Often, your Gold IRA company will recommend custodians they have a good working relationship with.
Makes sense. You want someone who knows the ropes.
Exactly. Your choice of these partners is really paramount. They're your first line of defense in ensuring compliance.
Okay, so getting the right team in place is step one. But it doesn't end there, right? It's also about staying on top of things yourself, isn't it? How important is it for the individual investor, for you listening, to stay informed?
Oh, absolutely vital. That's the second crucial step. Keeping abreast of IRS rules and regulations. Look, your custodian in your Gold IRA company, they're experts, they're helpful. But ultimately, the responsibility for your account's compliance, it rests with you, the account owner. So it's really important to familiarize yourself with these rules, understand the basics we've talked about today, and stay informed about any changes. Rules can evolve. A really proactive approach is to Maybe periodically conduct your own sort of mini audit of your Gold IRA. Just review things. Make sure all the transactions, the holdings, everything meets IRS requirements.
Well, it's definitely not a set it and forget it kind of investment then.
Not at all. That personal oversight helps you catch potential issues early, avoid costly mistakes, and make sure you keep enjoying all the benefits of your Gold IRA.
Okay, so let's wrap this up. What does all this mean for you, the investor, considering or holding a Gold IRA? We've really unpacked some crucial rules today. Those strict penalties for things like early withdrawals, the absolute ban on storing gold at home, the traps you can fall into with excess contributions, the non-negotiables around RMDs, and those very specific requirements for what kind of gold is even eligible. I think the big takeaway is knowing these rules, and just as importantly, understanding why the IRS has them. That's truly your best defense against some severe penalties.
Couldn't agree more. And if we connect this back to the bigger picture, it's crystal clear that the set it and forget it approach, it just won't cut it for Gold IRAs.
Yeah.
The sheer nuance of the IRS regulations, their insistence on that formal trust relationship with independent custody, it means active oversight. It means being informed. That's absolutely key.
Definitely. So here's a final thought for you to mull over as we close out today. Given these really strict rules around Gold IRAs, especially thinking about the storage requirements and the specific types of eligible metals, how might that reality shape your overall retirement portfolio strategy? And maybe what other factors, going beyond just the potential tax benefits and diversification, might you now consider when you're exploring physical asset investments for your future? Something to think about.